Hello and welcome to Daily Finance Wrap. I'm Mubina Kabasi, and this is the show where we get you everything you need to know about personal finance, the markets, and all the top stories of the day. And of course, we get you top tips with respect to personal finance, be it investing, insurance, taxation, or more, right here on the show with the help of our personal finance expert. We have lots lined up for you today, starting, of course, with the top stories. And it has to be around the big market crash that we saw engulfing the stock markets today. The bears definitely took charge as we saw the headline indices, that's the Nifty and the Sensex, dropping by more than 1% in trade today. And if you look at the mid and the small cap index, the carnage has been much, much more deeper over there, with a 2.5 to 3% cut coming in for the mid and small caps. But that's really the nature, right, of the broader markets, where there tends to be a bit more volatility for the mid cap stocks and the small cap stocks. And I guess that's the reason why we say that the benchmark indices or the large caps are a bit more stable. But anyway, back to the story then. Nifty and the Sensex dropping by more than 1% in trade. The overall market capitalization of the firms listed, in fact, on the Bombay Stock Exchange plunged by almost about 9 lakh crore rupees. Only three stocks, ICICI Bank, Nestle, and Infosys, managed to just eke out some extremely small gains. But all in all, most of the stocks were in the red. The balance 47 stocks and the Nifty were very much in the red, losing in trade today. In terms of sectors, PSU banks, 4.1% gone for that index. The realty sector down by more than 3%, almost 3.5%. The metal sector crashed by 3%. So these were some of the biggest losers in trade today. It's interesting to note that the Nifty 50 has now corrected almost 7% from the record high levels. So this is a big, big correction. And I think it's going to be interesting to see that how the markets will move from here. I think in terms of what affected the equity markets today, well, there's sustained geopolitical tensions. Then there's, of course, all the uncertainty surrounding the US elections, where still, of course, pundits are saying that it could swing anyway. And then the continued sell-off by foreign portfolio investors. This month of October is something that's been seeing particular relentlessness in selling by foreign portfolio investors. So that as well is weighing in on market sentiment quite significantly. So that's, of course, the market report for you. Not looking very good for the bulls as the bears take charge. The other big headline is the Hyundai Motor India IPO, the biggest one that had hit the street. And unfortunately, it listed on a day, or it found itself trading on a day when the bears were really taking charge on the Lal Street. So it's unsurprising then that the debut on the exchanges was at a discount, though not a very large one, and a 1.5% one. So the stock on the Bombay Stock Exchange listed at around 1,931 rupees compared to the issue price of 1,960 rupees. And on the NSE, it listed at 1,934 rupees. Remember that the IPO was fully subscribed 2.3 times. The full subscription, of course, was achieved only on the last day. Valuations are fully priced. The issue is, of course, a complete offer for sale. So the company will not actually be getting any of the proceeds, from the investors. All of this will be going to the parent company, which, of course, is being done for more research and development. So that's Hyundai Motor for you, listing at a discount to its issue price. And I'll tell you why this is particularly disheartening, because most of the issues that we have seen so far hitting the Indian bourses have been received at a much higher premium compared to their issue price. So this one particularly will be a bit disheartening for Hyundai Motor investors. Then we have also had the story around gold. Well, when equities fall, we do tend to see some excitement around gold, and that's exactly what happened. Remember that precious metals as a whole has been doing very well. Gold prices yesterday hit a record high. Silver prices were at a 12-year high. And today as well, that upward momentum continued. As we speak, we're a bit shy of that record high level, but we are seeing strong demand in the local spot markets as well. I guess this is a mix of good and and bad news, especially because we do have the upcoming festive season, which is when a lot of people will want to buy the shagun precious metal or a shagun piece of gold or silver for themselves, especially during the auspicious time of Dhanteras. Well, I guess that's going to be coming in at a bit of a more pricier value in this festive season. But of course, nevertheless, gold and silver is a metal that all of us have in our portfolio in some form or the other. So some reason to celebrate, nevertheless. So yes, gold prices hit their highs. The surge in US dollar, though, did cap the rise in gold by a tad bit, but 78,000 and above, so almost 78,500 is where gold hit in the local markets, and silver at 98,600 per kg. That's roughly where the prices are at. And gold and silver are often looked at as a safe haven asset. So when things are going awry in the risky asset classes like equity, investors do sometimes tend to look at gold, and of course in India all the more so. Well, those, of course, are your top stories of the day that you must keep a track on and must know about. But today's discussion is going to be around NFOs, or new fund offerings. To put it in a nutshell, just like when a stock or a company has an IPO or an initial public offering, even a mutual fund house, when they want to issue units of a brand new mutual fund for the first time ever, they come out with something called as an NFO that's open to people like you and me to subscribe to. So that's when we buy the first ever units of a brand new mutual fund. And the reason why we are discussing this is because of late we've seen a whole lot of mutual fund houses come up with these NFOs or new fund offerings. They're launching very specialized NFOs. They're launching thematic NFOs. So we are going to be dissecting from a retail investor point of view. Firstly, should you be investing in these NFOs? Secondly, what are the different parameters you look at these NFOs? Because when it's a regular mutual fund, we always, however wrong it may be, we do tend to look at the past performance and then try to figure out how well the fund has done and decide whether we should invest. But obviously, there's no such thing as past performance when it's a new fund offering. And then thirdly, considering that the nature of these NFOs is very thematic in nature, should you be having any special knowledge or wherewithal before you consider investing in these thematic NFOs? To discuss all of this with me, I have Kalpesh Ashar, CFP and SEBI registered investment advisor. Hi, Kalpesh, and thank you so much for joining us on Daily Finance Wrap. It's great having you with us. We'll be with Kalpesh in just a moment. I do, of course, want to talk about the fact that a lot of these NFOs are very thematic in nature. So we are talking about EVs, we are talking about technology, we are talking about AI. So it's interesting to know that how specialized all of these NFOs are. So the question is, how should you consider these? Because when it comes to thematic funds, you do tend to have a certain level of entry and exit points that you must know. When should you enter? When should you exit? And also, when is the right time to, so how long rather should you stay invested? Now, mostly when it comes to mutual fund investing, you do have to have a more long term time horizon, but sometimes entry and exit becomes an important point invest rather thematic investing, because there is possibly a right time and a wrong time. For example, if we have let's say a scheme like a EV scheme, then an EV fund, pardon me, then it's possible that the government may announce a certain policy that's beneficial to EVs, and that's when you will see the EV associated stocks really rising. But then later that rise in stock price may peter down. So you should actually know when and where is the right time to enter a thematic fund and when is the right time to exit it. Remember, we had this entire discussion on thematic investing right here on Daily Finance Wrap a couple of days ago, and you will find the entire show right there on Personal Finance TV on our live video section. So do, of course, connect to that and give that video a view as well. But remember that we'll also, of course, be answering viewer questions and queries. So folks, if you have any questions you would like to get answered, do put them in on that chat box over there, and we will try Kalpesh Ashar. He will, of course, get those. He will be happy to answer any of your questions. But for now, let's look at what else we have right here on Personal Finance TV.
What's the number of credit cards that you've got?
10 can be a number that we can use. I don't use more than 10-15% of my total.
That's it. Are viewers out there who want to understand the spectrum of expenditure, which is most rewarding?
The highest I've ever got is about 33.3%. And all our flights and hotels were 80% paid by my reward points.
How hardcore do you have to be into knowing all of this?
You could go as deep in it as possible. You'll end up in a rabbit hole and end up spending a lot of time and effort for unproductive returns, honestly.
I want to get to that actually.
Yeah.
Let's talk about that.
Well, that Finance TV. But back to our topic then, NFOs, and Kalpesh Ashar is with us. Hi, Kalpesh. And I think without any further ado, let's start off with this entire topic. Mutual fund houses have been launching a lot of NFOs this year. But firstly, do you think retail investors should be looking at mutual funds in this NFO stage?
Thanks, Mubina, for having me here on this show, and always a pleasure interacting on a personal finance show with you. So this topic of NFOs, which we've been seeing, for a long time, and we've been discussing it, far and loud in every, show or every medium, is a very touchy topic, because what happens is generally it's a two-way process, because the AMCs obviously have to keep on dishing out the NFOs, because it's a part of their process to increase the business, to offer new products. And obviously there is investor interest at heart, but let's not forget they are also into a business, so they need to keep churning out these new NFOs at various intervals. Now, the turning point for me, I think, came in 2018, when SEBI had recategorized a lot of mutual fund schemes and opened up a lot of different segments for AMCs to fill up. And that, in fact, brought in a lot of new entrants into the NFO space. So AMCs which didn't have certain categories were busy filling up their slots accordingly with the large cap, mid cap, flexi cap, multi cap, small cap. And that was happening for a while. And as the markets progressed, and then we see that we had the COVID period, and the markets were on a one-way tear upwards, then they stabilized. And now in the last 2 years, we've seen that the markets have 1.5 or 2 years, the markets have been on a roll, and always they have been, most of the times they've been on a positive side. Now, the AMCs obviously want to capitalize and cash in on this euphoria, the sentiment which is there, and they have been churning out NFOs. Every sector has been, looking promising in a cyclical manner, and there have been thematic funds, there have been sectoral funds, and there have been, lot of new age, companies which we talk about. There have been themes which have been unheard of earlier, and now they are being pushed forward. So what's happening here is that there is a surge, there is a plethora of options which the NFOs have now given the retail investor. But the crux question is that, does the retail investor need all these in his portfolio? Because everything new is not necessarily good for a portfolio, in retail investors' portfolio, because an experienced or an evolved investor already has been into the markets for quite a long time, and he already has his slots filled up with a decent amount of large cap, mid cap, and you have it in a diversified portfolio. There is absolutely, at some point of time, no need to keep on putting on an old wine in a new bottle type of a concept. So NFOs per se have to be looked at in a very, I think, sharp way, but yet in a passive way, that everything what comes out need not be lapped up by the retail investor, and he needs to look at his own portfolio and then evaluate and take a call.
Understood. All right. So let's talk about that evaluation process then. What is it that investors should look at? Because, however wrong or right it may be, when we look at a mutual fund, automatically the first thing we want to look at is at that, okay, how has this mutual fund done in this last 1 year, 3 years, 5 years, so on and so forth. So, however right or wrong it may be, that's the first parameter we tend to look at. But of course, with NFOs, we don't have such history. So how do you evaluate that then, Kalpesh?
So that's exactly, I think the answer lies in the question itself, Movina, because uh, although, like what you rightly said, that we do not look at past returns whenever we select a mutual fund, but most of the time it's human nature that people would look at returns as one of the main parameters and then take a call. But in NFOs, it's a paradox that even the past returns of that performance is not there to fall back on, and people still want to go for it. That's the word new fund offer a variety, and even the distributors at times, or even the AMCs, I would say, harp on the topic that it's a 10 rupee type of an NFO which has come out and it's cheap. And I think those are myths which people need to get out of, because as we've seen that even if you understand the life cycle of a fund, it has to undergo a lot of business cycles. It has to undergo the ups and downs of the market, the volatility, and in those testing times, how this particular fund performs should form the criterion of selecting a fund. So NFOs, if you were to select an NFO, it has to be completely a different kettle of fish which you don't have in your portfolio. So if you have the same, large cap or a mid cap or a multi cap, and if an AMC is taking out a NFO with the same theme, I think it's best ignored if you already have that slot in your portfolio. And if it is something very unique, so in last 2 3 years we had a lot of international funds before the RBI limit set in. So if those international funds geographically add diversification, so be it. You can look at that as a NFO to look at if you want to get into that. Of late, there have been a lot of different themes, I would say, which have been coming out, like AI or the blockchain technology or the EV themes or the new age companies which are there. So if you are understanding what is that business, if you feel that you can dedicate a small portion of your corpus to those type of things, so be it. But again, there is always a hanging sword or a risk that you might just end up with too many schemes in one portfolio just on the name of diversification. And in mutual fund, as people who decide that you should not have too many schemes, again, that's a dilemma, a catch 22 situation. So my main point, the core point which I'd like to make here is that when you have an NFO coming out, unless and until you have dissected all the risk parameters, you have understood that what industry it belongs to, what is the entry level and what is the exit level, more importantly, when you're getting into this particular theme or a sector, I think it's best avoided. Because even in nowadays in a diversified mutual fund, so if you have a flexi cap fund or a multi cap fund or even a small cap fund, many of the existing funds also take an exposure to these new type of concepts when they buy the different companies. So I don't think that you're left behind if you don't particular subscribe to a NFO. But if you're doing it, do it very judiciously. And most importantly, Mubina, that any mutual fund scheme you select should ultimately be taking you to achieve your financial goals. It's not about being a part of a fad or a FOMO type of a thing that you're missing out on something. Because of late we've seen that there was a surge in PSUs, there was a surge in the defense stocks, there was a surge in banking. At times there was a surge in all the power and infra, and no AMC wasted any time in coming out with an NFO to capitalize on that. And these are all very cyclical themes. You can get in when the going is good, but you really don't know when to get out of it. So you have to be very careful. You have to have your advisor by you, who dissects every decision for you, and then decides and tells you whether this is good or bad for you.
Okay. I think you raised a very important point, that there are certain fads which do tend to which do tend to be cyclical in nature. I guess that also explains why there are so many EV funds being launched. there was a time when there were blockchain funds being launched, new age digital funds being launched. So I think you have to look at your portfolio in a very holistic manner, and of course, consult a financial advisor before you say that, hey, listen, this looks like an exciting theme to be, and everybody is investing in AI in some way, so this is how I can get exposure. Kalpesh, to what extent does fund house matter here? Here's why I ask you this. Many fund houses are backed by banks. Banks are tend to be the most influential medium for a lot of investors. Just to give you an example, bank ABC, if I'm banking with them, they will probably tell me that, hey, listen, ABC mutual fund is also very good, for obvious reasons. So, does fund house also matter if it's a reputed fund house that's coming out with this NFO?
It's a very, very important and yet I would say a complicated question. See, what happens generally is that you hit the nail on the head, Mubina, that many fund houses have this bank pedigree with them, and that's why the reach is huge. But does the fund house, the question to be asked is, does the fund house have that wherewithal or the research or the expertise to launch that type of a thematic or the sectoral fund which is there? And that for that, I think it's not a layman's job to dissect that or to analyze that. It is up to the seasoned advisor or the distributor, if you have, to understand that this particular thematic or a sectoral fund, that NFO which is being launched, has come out from an appropriate fund house. Does it have the the able research or the pedigree to take this NFO forward? Because everybody wants to just wet their legs or feet into the flowing I would say the fad of NFOs. But then what happens is that you are left with just that emotional content that you participated in it. But when you look at the actual returns, or whether you look at it whether it plays a very integral part of your portfolio, I think you're left high and dry. So the fund house selection also is very important as to which NFOs. Now, there are fund houses, I would not like to name them, which want to have NFOs coming out at the drop of a hat. I don't think that is the right thing, because they are just like a manufacturing factory. They keep on churning out whatever is available, whatever they want to capitalize on. Other fund houses are also, they come what may, they resist the carrot of launching NFOs because they are so adherent to their principles, or come what may type of a principle which they have in mind, that they will not fall prey to this NFO story at all unless and until they find it compelling. So I would rather go with the latter part of AMCs, which do not come out with NFOs at the drop of a hat. And whenever they come out with an NFO, I think it's worth pondering that this fund house, which normally does not come out with NFOs, they've come out with a new NFO, so there must be some crux or juice in it.
Understood. Okay. One question with respect to expenses, because when it's an established mutual fund, of course, it would have many more investors. The expenses with respect to the mutual fund house would also be distributed. But do you think that at the NFO stage, when the subscription has just closed, do you think that logically it would be a bigger expense burden for the NFO stage investors too?
No, see, ultimately it would all boil down to how much the NFO collections happen, because SEBI has categorized it and capped it at 2.5% as an expense ratio. So, how much is the collection? There's a different slab-wise percentage which the expense ratio has to fall into, and once the size of the NFO grows, I think the expense ratio is capped or tagged accordingly to it. So at the NFO stage, I don't think the expense part of it, because we all know that if there is, the smaller the fund which is there, the expense ratio goes accordingly, and larger the fund as it grows, the amount of expense is proportionate to that. So it's not really relevant at that stage when you're deciding on whether you should subscribe to an NFO or no. From the expense point of view, what is more important is the question to be asked is, do you need to invest in it at that point of time, looking at your own portfolio?
Okay, understood. Of course, remember, folks, that Kalpesh is here to answer any questions or queries that you may have, whether with respect to NFOs or just in general investing. So do send them across to us. You can, of course, comment on the comment section right there on the YouTube live stream. Kalpesh, just to sum it up in conclusion, I will not look at thematic NFOs. That's well established. But let's say if a mutual fund house is coming out with a flexi cap fund NFO or a multi cap fund NFO, what would you pick, Kalpesh? An existing multi cap fund, or would you put your money in the NFO of the same category?
I think without doubt in an existing multi-cap or a flexi-cap, whatever. Because as I told you, multi-cap and flexi-cap is not a novel thing which has been introduced. It's been there for ages. And every person who's participated in the mutual fund story has known what are multi-caps, what are flexi-caps. And there you already know which are the winners and which are the average performance and which are the losers, which over the business cycles or the market cycles have performed or otherwise. So I would any day go in for, if it's a flexi cap or a multi cap or a large cap, small cap, what have you, I would go in for an existing proven scheme in terms of all the fundamentals and parameters.
We actually haven't touched upon another risk that investors face if they sort of try to catch every fad or try to look at every NFO, and that is cluttering your portfolio. So you already have, let's say, a large cap fund, mid cap fund, small cap fund, and then you get tempted by this NFO that has come out, EV NFOs, new age digital NFOs, so on and so forth. To what extent is adding too many funds in your portfolio a risk, and what are the consequences of having too many funds in your portfolio?
So it's very dangerous, Mobina, because we've seen people just piling on schemes which have been suggested by them, or they've gone as per their own choice or something. And what it does is it simply overlaps and dilutes your returns. Even monitoring of your portfolio becomes so difficult because you have so many schemes. And ultimately, when you see that if you have a certain analysis done, that 50 to 60% of the stocks which the schemes have are more or less overlapping. So it really doesn't benefit anybody to have this cluttered portfolio type of a scenario, and it just doesn't let you, I think, sleep well at night as well, because you keep on comparing the returns, and with so many schemes, I think you are at complete I would say a pathetic stage of mind that you don't know what is performing and what is not. So even if you ask me what is a model portfolio, I would say that whatever the size, I'm not saying of huge amounts, but a decent size of a corpus which you have, you genuinely don't need more than maximum 6 to 8 schemes in your portfolio. That does the job. And that 6 to 8 schemes can give you a complete spread or a diversification across the market categories, obviously keeping in mind your risk profile, what is your risk taking capacity, and most importantly is your goals. So if you have a decent 6 to 8 schemes in your portfolio, I think you are done, and those ensure that you will reach your target or your financial goals, because monitoring is very easy in that. So a decent mix of large cap, flexi cap, mid and small cap, I think should do the job. If you feel, as I told you earlier in the part of the show, that a sectoral or a thematic fund or a completely new concept has been introduced, I don't think it should form more than 5 to 10% of your entire portfolio. Give it a shot, give it a try, but don't let it completely envelop or rule your portfolio, because it's just a passing phase, and passing phase cannot be the integral part of your portfolio.
Understood. So, net, yes, NFOs could be an interesting opportunity, but first understand everything about it thoroughly. Only if you think that there is a hole in your portfolio which that NFO can fill, which can help you achieve your financial goals, only then go for it, but not without consulting your financial advisor. And of course, not too many funds in your portfolio, 6 to 8, more than enough. Kalpesh, we let you go on that note. Thank you so much for joining us.
Thank you, Mobina.
All right, well, that brings us to the end of another episode of Daily Finance Wrap. Hope you enjoyed it. We'll be back with yet another episode, same time, 6 p.m. live right here on Personal Finance TV.